Good. How are you doing? Happy New Year.
Happy New Year. What's new? What's going on?
Well, I'm watching Carvana and Tesla take a break right now.
Yeah, Tesla is doing more than take a break. Tesla is down today by about, let's see, the latest, 7%. Tesla's down 7% today. After deliveries disappointed. Tesla is down 20% in the last 5 days. Tesla 6 is down 20% in the last 5 days. So that means to the extent that some people relied on margin to add to their shares, whereas the stock was surging above 400. We might be getting some margin calls on Tesla stock. Um, I don't think that's necessarily the reason why the stock is dropping down today, but I think that we might see an acceleration of this trend if the stock continues to drop. What do you think about that?
Yeah, I think I felt this way for a while. We had interest rates higher for longer, and the market continued to accelerate upwards. And and now that we're in the new year, I'm sure people are willing to sell and pay the taxes next year. So yeah, I think you could see a lot more downside here.
Yeah. I revised my price target for Tesla to $100 per share. Kind of thinking more about the just thinking more about the 2025 deliveries. I think for a company that has 0% year-over-year growth in deliveries in 2024 and then 2025, so 0% growth. Thank you, Steve, for letting me know that audio is good on YouTube. And if you all could please let me know in LMX as well that the audio is good, you can reply to the space. Um, Um, so if you have a company that's not growing, 0% this year, 0% next year in deliveries. Okay, we'll get to energy in a second. Um, then you're kind of looking at a situation where, okay, well, automotive wise, you're looking at hybrid sales surging across the world, China, Europe, and US from many companies, Toyota in the US and BYD elsewhere. And BYD and Chinese automakers are expanding into international markets, challenging market share. I mean, my understanding is that Chinese automakers now comprise between 40 to 50% of global sales, and that's rising, because they have lower production costs. So I would expect that to continue to rise in the foreseeable future, especially in 2025. Okay. Um, which is pushing other companies, let's say Volkswagen, Mercedes, etc., and Tesla, to lower their prices and do production cuts. So, we've seen Tesla lower production throughout this year every now and then. Volkswagen just agreed with their UAW, with their union, labor union Germany, for 36,000 job cuts. They're going to close a number of factories, stop production lines in a number of factories, and and I think this is just the tip of the iceberg in the automotive industry. You've seen Nissan trying to sell itself to Honda. That will probably go through because both are Japanese automakers, and the government is probably encouraging that transaction. But there's tremendous um, unused production capacity across the automotive industry and across the world. Tremendous unused car production capacity across the world, which means all of these companies are now in survival mode. Survival mode. So it is in their best interest to lower prices to marginal cost per unit. And I know this is going to happen because um, um, because interest rates are staying high. If we all look at everything across the world is really based on the U.S. Treasury market, and the U.S. Treasuries are up today despite a challenging stock market environment. in the last few days. I mean, look at Tesla, look at Apple down 3%. Nvidia is the only stock that's holding up the entire market today. And it's been the case for the last several days. Nvidia stock has jumped quite a bit in the last month, in the last week or two. And they have an event coming up on January 6th, or I guess Jensen is going to make a speech in the CES event. So I think there's some still hype baked into Nvidia stock. There's a lot of retail investor hype in the Nvidia stock, a lot of margin use, call option use, leveraged ETFs. So Nvidia, given the significant rise in the last couple of weeks here, and not participating in the decline that we're seeing from other Mac segment companies, and combined with its high weighting in the S&P 500 index, it, in my opinion, is holding up the entire stock market. Now, on the other and on top of that, this stock has been surging now for 2 years straight, and there's trillions of dollars of long-term capital gains baked into the Mac 7 companies. And to the extent that people have been waiting for the new year to sell, to push their tax liability into the new year, presumably at lower capital gains tax rates or personal tax rates, now is the time for them to sell. And this isn't something that the markets can front run, in my opinion. So we've seen Tesla stock decline in the last few days. But I don't think I mean, Tesla started rising within the last 12 months. But Nvidia and other Mac 7 companies have trillions of dollars of long-term, like Apple has trillions of dollars of long-term capital gains baked into those valuations. So if I've seen a number of people trying to get rid of their Apple stock, but it makes sense, obviously, if you kind of reach that decision in December, to push off that decision until January makes sense. So I think January we're going to see a massive sell-off in the equity market, and Tesla's deliveries miss doesn't help that situation. Because if you think about it, what do investors or traders who use margin? What do traders who use margin and options to invest or trade Tesla stock also have in their portfolios? So if there's a margin, if they get a margin call today, and they have to satisfy this call by the end of the day or next day, the day after, etc. And let's say they try to add some capital in the first few days or whatever, but then obviously you run out of cash at some point. What else can they sell? Is one thing I'm trying to look into these days. What other stocks can be liquidated? I think in those portfolios, Nvidia is another one. Palantir is another one. So these are going to be high profile names, high PE ratios, people who say fundamentals don't matter flock into these same companies. People who use high leverage call options flock into these companies at the same time. And so I think we could see a massive drawdown in these stocks. Now, on the other hand, I'm biased, obviously, because I have a short position in Tesla and Palantir. And a number of other stocks that we're going to get to later in this space. There's a massive. Let's bring in Stephen, ACDC, if you could please come up. And then anybody else who want to say a word or two about Tesla Deliveries report, you're welcome to come up to the speaker board. Stephen?
Hey, thanks, sir. Can I talk about the Cybertruck in Vegas, or you don't want to mention that?
I mean, I don't really care. I don't think it's that important. I mean, on December 31st space, we discussed heavily. You have to stay on me when you're not talking. We discussed heavily the political lashback that Elon is getting from US, from Democrats and Republicans alike. These are far left and far right. Like, I think he's going to continue to gain the support of the middle in the future. I think there's a lot of people who also support Elon, but this division from far left to and far right against Elon is, I think, strengthening, and it's going to continue to strengthen. But we talked about that. And I think Cybertruck is just, a Cybertruck fire, obviously there's a link between Elon and Trump hotel that was kind of a Trump building. And then the other interesting note that people, I think it kind of got missed in the rhetoric on X is discussions on X is that F-150 that was used in New Orleans, that's a Lightning, F-150 Lightning. So both are EV trucks. So I think that's an interesting possible common point there, link as well. ACDC, welcome.
Hey, man. Happy New Year.
Happy New Year. What do you think about this? What do you think about the deliveries results first?
Yeah, it's pretty disappointing. I thought they would be closer than where they ended up, given all the incentives and promotions they ran. I mean, they literally threw everything at it. So it's pretty disappointing that they couldn't pull out a better number, and it makes me a lot more pessimistic for 25.
Yeah, I don't know. Did they have so James Cat? So I put. I'm gonna link a couple of his tweets at the top of our screens. Okay, so let's look at this. Is I mean, James Cat is a very good fundamentals analyst. I don't know if he has a discounted cash flow, but he's at least like minimal bias and reasonable person. And he says at the top of our screens, although margin will be much worse than Q3, then I can pretty much guarantee this right now, even before running the numbers. So he says much worse than Q3. I don't think that's necessarily true. But I think, like, I'm assuming it's going to be flat quarter over quarter. I think there's some benefit to declining battery costs, raw materials. So James Cass seems to be more pessimistic than me on auto margins, and he says why? Because 0% financing in the U.S., earlier start of financing in the U.S., high percentage of China sales, throttled production, CT price cut, Berlin wage increase in November. I don't know if the 0% interest rate carried out throughout the quarter. Do you know that at all, or does anyone in the audience who wants to come up?
I think the 0% ended. And I don't know it for certain, but I thought I read someone's reply that it ended earlier than
Right.
the end of the quarter.
Yeah.
And also, like you kind of mentioned about the DCF, I'm kind of curious as to how do they account some of the other discounts, such as free supercharging, free FSD transfers, if there's a way of even doing that, or some of this other stuff that they also they put in everything.
They threw the kitchen sink at it, but I'm trying to find that reply. Whose reply was it to that tweet that says 0% didn't continue or end? Let's see.
It was two. I think one of his replies where the guy said that he wanted to buy a Y for his mother and decided not to because the 0% financing wasn't there anymore.
Oh yeah. I mean, look, it's not all doom and gloom for Tesla stock. Okay. I mean, I do expect the price to drop substantially, but I think the long-term story is intact. But there's just in the longer term, I think the risks are underpriced. Even though like short term, the stock is toast, I think. But longer term, like 5, 10 plus years out, I think it's a great company still. But the risks around Optimus, I think, are underpriced in the company. But it's not like the company's gonna go fucking bankrupt. You know, so people need to be careful about these statements. Like, I don't think the 0% interest rate was carried out throughout the quarter. Now, it might be that they maybe, honestly, I think what happened was Tesla was expecting, this is just pure speculation, okay? But I think Tesla management was expecting these interest rates to continue to decline. And after the last Fed presser, mid-December, I think Elon made a call that, okay, we're not going to continue to buy these offer subvented loan rates. And so that may be the kind of last week or two. I think the demand was a little lower than I expected because of that change strategy. I don't know exactly when 0% interest rates ended in the US, but I looked throughout these like a couple of days before the quarter end. I'm like, I didn't see them. So if anyone knows, please reply to the tweet to the space, or let me know on YouTube live chat. When did 0% interest rates end in the US? ACDC?
Quick question for you. What's your take on energy? I think energy was a pretty good positive. How do you think that translates to buffering any of the earnings per share blow?
Yeah, so I think energy margins will increase quarter over quarter. I think they're going to be very healthy. And I estimate a $200 billion value for Tesla Energy as of today, intrinsic value. Just like $200 billion intrinsic value for Tesla Automotive as of today. So I value Tesla Energy similar to Tesla Automotive as of today, despite the fact that Tesla Automotive is a very mature business at this point. And Tesla Energy is just emerging. I think Giga Shanghai will ramp as expected throughout 2025. I think their margins will be lower than Tesla US margins in energy margins in the US. And I think Tesla energy margins in the US will decline eventually. But I think Tesla Energy is going to face tremendous competition in China and in international markets, just like Tesla Automotive is today. But despite all that, I still assign a $200 billion valuation to Tesla Energy. So if you look at their production capacity today in the US, you're looking at 40 gigawatt hours annualized production rate. Um, um, they're just starting from zero at Giga Shanghai, but they're going to ramp to 40 gigawatt hours there too, probably at the record speed or whatever. So let's say 80, and let's say they make some battery energy, like they kind of optimize their lines. Maybe they introduce higher energy capacity cells in the next couple of years. So they get to, let's say, man, look at this. Henry just replied and says 0% rates ended December 15th. And that's literally, I think, the date of the Fed presser. I'm telling you, I think after the Fed presser, Elon's like, oh shit, we can't continue these things because these rates are going to continue higher. So I'm guessing in the last 2 weeks, which would also explain why Troy even proved optimistic, because he doesn't get the last couple of days of data. So I think the last week or two for Tesla sales was way lower than people expected. Was pricing it because the 0% rates went away. So Q1 is going to be challenged. Q1 is going to be very challenged for Tesla. It's also a seasonal low, and so December 15 is close enough to the end of the quarter that I think most of the sales in Q4 probably had that 0%. Most of the deliveries probably had that 0% rate. And combined with all the other incentives are record price cuts. So hold on 1 second. Okay. That I think James Cat is probably right. Q4 margins, all the margins will be way lower than market expected. And that's, dude, if you have declining margins, record low margins, and zero and negative top line growth on the automotive, what is the value of automotive? And they were generating about $1 billion free cash flow per quarter. And so you're looking at, let's say $5 to $10 billion, like five if the rates continue to stay high, 10 billion per year free cash flow generation if the rates more normalize, which we don't know where they're going to normalize right now, right? So call it five for a second, so just a downside scenario. You apply to that 20 times, optimistically, 20 times price to free cash flow, like let's say 2030, you're looking at 100 to $150 billion market cap, for automotive. So that's way below my $200 billion. And Troy expects 1.8 million deliveries next year. And if people aren't subscribed to Troy's Patreon, you're making a huge mistake. Huge mistake if you're not subscribed to Troy Tesla's Patreon. So I highly recommend doing that. But he expects flat year after year, and I was expecting maybe more than 2 based on the Elon's guidance in the last quarter, but it's not looking like that. It's not looking like that, you know. And there's also execution risk, obviously, in the Model Y production ramp. So I don't know. And on top of all that, I think we're heading into a recession. But so that's my view on energy. I think energy. So we're looking at $100 to $200 billion market cap fair value for automotive, $100 to $200 billion market cap optimistically for Tesla Energy as of today. And now then we're left with robotaxis and Optimus. But the thing is, when rates are high and there is free cash flow issues, okay. I think Q4 free cash flow is probably going to be healthy because of the deliveries so much higher than production. But I think 2025 free cash flow will be even more challenged than 2024. You have a production ramp risk in your Model Y lines, the new model lines across the world, Giga Berlin, Giga Shanghai, and in the US. And that Tesla Energy is also going to have production issues and significant competition in China and Asia Pacific region from other Chinese battery manufacturers who produce their own cells. And you have high interest rates and a potential recession. You're going to see that price to free cash flow ratio drop from, I mean, it was 400. It probably came down substantially after the recent, 25% drop in the stock price. So we're looking at probably like a 300 price to free cash flow ratio. Let's say their cash flow improved a little bit this Q4. So you're looking at maybe like 250, 250 price to free cash flow. The correct number for that ratio is 30. So you're still at a risk of an 80% drop from here. These fundamentals matter way more than people think when there's panic and fear across the market. I'm not talking Tesla stock panic fear. I'm talking across the market, which I think is ahead of us. I mean, look at Nvidia stock today. My God, that stock was surging in the morning, and then all of a sudden it sold off 2.5% within a matter of like 20 minutes. Nvidia, $3.5 trillion company, sold off within a matter out of like no news whatsoever. So Nvidia is the only stock that's holding up to market, I think. ACDC.
What's your take on China? I think China has been one of the key strengths for Tesla on the energy side and the automotive side. But I mean, China overall is in the dumps, and they're being propped up and will be further propped up by government incentives. My take is that those government incentives are going to focus more on their own Chinese companies versus giving them away to foreign companies. Do you see that kind of playing out the same way or not?
Sorry, can you summarize that again, please?
So China's already announcing a lot of incentives, okay, to prop up their economy. And I'm looking at it this way, that more of those incentives are going to go towards their own companies versus foreign companies.
Yeah, absolutely. I mean, look at like people really again, going back to the Trump policies. When he came to power in 2016, it was a very different economy, and people really didn't know if he was bluffing or kind of real with these tariff wars. But I think the bond market tolerated his take on things on tariffs because inflation was low. The Fed had been struggling for a decade to get inflation higher, and now it's the opposite. The Fed is struggling to bring inflation down, and there's no question tariffs are inflationary, all else equal. Okay. And BYD is not selling in the US. Why isn't BYD selling in the US? Of course, because of government protection policies, protectionist policies. And Ford, GMs of the world can't compete with BYD. Can you imagine if BYD was in the US today? expanding their market share like they are across the world, in Norway, in Latin America, Asia Pacific, outside of China, and in China. Can you imagine what the numbers would look like if that were the case? So the US is taking protectionist policies to prevent from all their companies going bankrupt and all millions of employees being laid off. And because of that, I think China will respond. I mean, Tesla and Elon have had favorable, reception in China, but there's a limit to that. When Tesla opened up this Giga Shanghai, BYD and others were not anywhere close to where they are today in terms of EV production. But today, BYD has become a top 5 global automaker, even at this early stage of expanding internationally. And consumers have voted, at least in the near term, that they want hybrids, that they don't feel psychologically ready to hop over to the full EV side. And BYD is producing hybrids. I mean, they have been for many years, and other Chinese automakers do as well. And now we're seeing legacy automakers in the US and Europe also focus more on hybrids than EVs in response to consumer sentiment. So I don't see Tesla producing hybrids. I mean, do you? I don't think that's ever going to happen. So Tesla is going the other way, which is they're doubling down on the EVs with these new models, and they're doubling down on FSD. I think that it will play out in the very longer term. I think that, as I mentioned and I posted on one of my tweets, and George Potts replied that he agrees with my take on that as well. I think it's going to take 5 to 10 years for Tesla robotaxis to become nationwide, to get nationwide adoption in the US. But even on that front, in Optimus, in robotaxis, you're going to see the same protectionist, policies from Europe, which still hasn't approved FSD use, which is crazy. Like they're killing their constituents. And China, which BYD is now building its own robotics team in house, and so like everything that we're seeing automotive is going to apply to energy, is going to apply to FSD, is going to apply to robotaxis, is going to apply to Optimus, unless something really big changes, which I don't really see in the near term. Like China is going to wake up overnight and say, you know what, we do welcome FSD. We do welcome your robotaxis to kill our BYD and other Chinese automakers. It's really sad, but I think this is just the way it works. What do you think?
I agree with you completely. I'm surprised that the relationship has been as strong as it is right now. But when push comes to shove and they have to, help their own economy, which they're doing right now, they're really not going to have a choice. And further retaliatory stuff is going to take place when we start placing tariffs in place.
Yeah. Did you see the news around Cybertruck qualifying for the $75 credit? What do you think about that?
I did. I mean, it's a slight positive. I don't think it's a big, positive in any which way. I mean, you're talking about still a $80,000 truck, okay, and it's a truck that's targeted at a limited market. So those people by far are not, making their decision or basing their decision on a credit. If somebody wants to buy an $80,000 truck, if they don't get $7,500 off, it's not a deal breaker. It is a deal breaker, maybe somebody who's buying a Y or a 3. So I really don't think it's going to be a big positive for it.
Yeah. XAI.
Yeah, I just wanted to speak a little on the Cybertruck. I want a Cybertruck, but for me, I have 2 kids and 2 dogs that I always travel with, and there are just so many better options that would fit my family. So when I think about buying a Cybertruck, it's something I want, but it's probably just not a fit.
Okay, any other comments, questions on Tesla? Please request to speak. For the first half hour, we talked about Tesla. The stock is down 7%, $1.2 trillion market cap. It says PE ratio 100, but that includes a massive and non-cash deferred tax asset related benefit in Q4 of last year. And that's going to wash out after Q4 results are announced. So the real P ratio is more around 150 to 200 right now. And so ACDC?
What's your perspective on the earnings? They just postponed the earnings from the 20th or so to the 29th. And
Who did?
Tesla.
Oh, really?
I think the new date is 29th of January.
Well, I mean,
So,
I don't think they ever set the 20th as a date, right? That was
right, but usually I think it used to be like the third week or something, and maybe not the absolute. So I don't think that's a big deal in terms of that, right? That could just be because of the inauguration with Trump on the 20th, so that it could be coinciding with that. But my take is that Tesla stock will sell off here. I predict the market's going to show its weakness. It's going to have a lot of profit taking from the 2 years of immense strength we've seen, okay, in the market overall. Tesla will go along with it to a greater degree, given the beta it has, okay. Do you think that the stock could bounce back on earnings report after it's sold off, if it's sold off?
It depends on how much it sells off. Like if it goes to 100, then sure. If it goes to 200, maybe. But until we get to 200, I don't really see a relief here for Tesla stock.
Because last time, so that's what kind of led the stock to pop up, right? I don't know the exact details of it, but they were able to manage and eke out some good earnings report, especially on the margin side. Do you see any surprises for this time, or any lever they could pull on that front where they could still at least, deliver good earnings?
I think energy margins will be very strong. I think Tesla energy margins in Q4 will be very strong. Record margins, because this is the first quarter where we see full capacity production deliveries for Tesla Energy. And we're looking at, I think, more than 30% gross margin for Tesla Energy, if not more than 35%. But I don't think that's going to be enough. Like I said earlier, I think Tesla Energy market cap is about 150 to 200 billion dollars fair value after Giga Shanghai ramps. Okay, but I'm assuming no production ramp issues at Giga Shanghai, which is probably a safe assumption. I mean, they're really good at ramping production there. And but I think Tesla Automotive, without FSD being robotaxiable, is worth very little, unfortunately. And I think robotaxi Optimus are 5, 10 plus years away. So even if you have perfect scenario for Tesla Energy today, you're looking at $200 billion. You're looking at $150 billion for automotive. You're looking at, so that's 300 to 350. And optimistically for Optimus or robotaxis, you're looking at about 100, 200. So you're looking at still 5 to $600 billion of market cap. And we're at 1.2 trillion. So I don't expect any sort of relief until Tesla stock drops to 200. And then after that, whether it gets to 100 or not, probably going to depend on how the economy is looking at that time, which I don't see it looking good right now.
Do you predict the margins to decline again after coming back up last quarter?
I mean, isn't that you mean automotive margins or overall margins?
Just overall margins.
I mean, I was assuming flat. Margins will remain depressed. I think margins will be flat overall. Like let's say net margin flat overall. So if it drops below that, then obviously that's worse, and that makes the $100 per share scenario more likely if they continue to drop. But I mean, look, man, I think the bottom fell off in terms of capital goods demand on mid-December. I think housing sales are low, housing demand is low, car sales, car demand is low, and this is before we get EV tax credits potentially going away, and further stress on the economy due to some of these student loans resuming. And like, for example, I just retweeted someone in macro analyst account. So he says, Michael Green says, I think this guy has a bit of a negative bias, so take this with a grain of salt, but he says, quote, we found, so this is from a FICO.com blog, okay? We found that the 18 million consumers with a scheduled federal student loan payment of more than zero as of October 20. So some 5 million consumers as of October 2024, some 5 million consumers have not made any payments since the end of the pandemic era federal student loan forbearance. Therefore, a significant number of consumers are at risk of having a delinquency reported to their credit files if they do not resume making their required payments. And I think these, you know, assistance, government assistance for houses and student loans, etc., have been kind of coming off gradually, but not really. Like I think these things take time. The lenders need to continue to ask for payments, and then it needs to be reported to credit agencies, and then an S curve shape. Number of people will find out that they're being asked to repay, um, try to make ends meet, and you potentially fall behind 30 days, 60 days, 90 days delinquencies, and some will go to court and etc. So this will take um, a number of months. I think the economy will continue to worsen throughout 2025, and I think the stock market will front run that. And this combined with trillions of dollars of long-term capital gains baked into these Max 7 companies, people waiting to sell their shares to push their tax liability to 2025. I think this is it. I think Nvidia is the only company right now that's holding up the entire stock market, and I think that's rolling over too. Nvidia hasn't been able to make a new high in a long time. Nvidia stock is basically flat in the last year. In the last 68-month period. So Nvidia made a high on local high in June 18, 2024 at $136 per share, and that's where it is today. So since June 18, in the second half of 2024, Nvidia stock is flat. The 52-week high is $153, and it's come down substantially from that level. It dropped as much as 20%. It recovered a little bit in the last week or so, and the stock is trading at what seems to be a reasonable PE ratio, but that's only reasonable if you assume their growth will continue as it has been in recent years, which is a massive assumption. So I actually see a negative earnings growth for Nvidia in the coming years. We talked about this in previous spaces. Microsoft, their biggest customer, is seeing their cash balances decline. So Microsoft has to make a decision. Do we buy more GPUs, continue at this tens of billions of dollars of spend rate, given to Nvidia without seeing any sort of meaningful profit increase from these investments? Or do we stop, or do we continue stock buybacks, which they also do? Or do we shift money elsewhere? Because they can't continue to suffer from this declining cash balance. Cash and short-term equivalence balance has been declining quarter after quarter for last year for Microsoft. And that's Nvidia's biggest customer. And Amazon, another biggest customer, is now building out their own in-house training chip, Trainium, partner with Anthropic. and training Claude on their chips. So I think that's going to be another increasing trend. Tesla is running into fundamental issues. Another big customer of Nvidia. Tesla's spending about $1 billion a quarter buying these chips. So I think this is going to be true across the board. And Nvidia's CEO has said in previous calls that he expects, these Max 7 companies to continue to buy, but even if they, stop buying at the high rate, that the 493 companies will pick up the tab. I don't think that's going to happen. So I don't think we're going to see, Chipotle training their own foundational models with their in-house training computer. So, let alone the Russell 2000 companies, the small cap companies that are struggling to even hold on to their employees because they don't have any profits. So I think Nvidia, I've been tweeting out all my short positions. Nvidia is the only one where I haven't made any money yet. That one's on negative, but I think that will also play out as well in the near future. I think that's the last shoe to fall, but we'll see. I do want to talk about Carvana a little bit. Any questions, comments on Tesla or Nvidia, ACDC or XAI? No questions or comments. Let me look at YouTube live chat. Kevin Weber says energy will sink big time when EV energy credits are repealed by Republicans. And Kevin Weber also says you're right on the price going down to 200. That's a prediction. Any other comments or questions on Nvidia or Tesla? Please request to speak. Otherwise, we're going to look into Carvana short research report. So Carvana, I made some money on there, but I think the potential for Carvana to go down even lower is massive. And there was a recent short seller report published by Hindenburg Research, which has a pretty good record. I mean, they made some bad calls in the past, but nobody's perfect. I think overall, Hindenburg Research does pretty thorough analysis. I've seen their previous research, and we're going to go through their Carvana research report in a second after XAI asks his question. Interestingly, after that research report was published today at around 10 a.m., the stock went from $186 per share to $212 per share. So it went up about $26, which I've never seen before in my life. A company's stock surging like that after a short seller report being published immediately. And the stock kind of traded at those levels between 205, 210 for about 2 hours. And then since then, it's given up all of that gain again. So tremendous volatility in Carvana's stock today. And I think this is one of the most overvalued companies across the stock market. Today trades at about $40 billion, P ratio of 21,000, which obviously is meaningless. The point is that the bottom line is zero. And the research report points to some insider selling, some intercompany related party transactions. So we're going to go through this, and also industry challenges, which I think is very applicable to Tesla investors because these are things that we've been talking about. Carvana volume shares traded through now, so a little over halfway through the trading day, is 7.2 million shares. On an average volume, on an average day, is 2.7 million. So they're already triple the average volume a little over halfway through the day. So this is a really interesting case, in my opinion. And I think the opportunity to short Carvana stock is still there for those of you who are trying to hedge some of your market risk or industry risk as well on your Tesla holdings. XAI, go ahead.
Yeah, we talked about Carvana. I think you were spot on. Kudos to you.
Thank you.
When I'd like to hear more of your thoughts on Microsoft when you get a chance, if you have more. But I know we're on Carvana.
I mean, Microsoft, I've been saying for like a year now, it's an overvalued company. And they made some big investments that are uncertain to pay off. They, bought into OpenAI. They bought these tens of billions of dollars of Nvidia chips while kind of saying, some of these big Mac 7 companies CEO comments are just really absurd. Like they're saying something like, the risk is that we don't participate. So they're like, shoot first, aim later, which is a huge red flag, obviously. And Microsoft is like, they're the lead of those, And but I don't think, obviously, I don't think, like, I would put Microsoft in the camp of like Nvidia, and fundamentally they're not going to go away, or Tesla, they're not going to go away. And in the longer term, probably a good stock to own, but in the near term, very overvalued. And to the extent that these companies are buying back their stocks at these overvalued prices, in my opinion, they're destroying value. And this kind of like shoot first, aim later type of tens of billions of dollars spending. I mean, that's one thing if you're doing this with like a $1 billion acquisition. It's another thing if you're spending tens of billions of dollars with the mentality of shoot first, aim later. That's a management problem. Tesla doesn't do that. Tesla doesn't have the money to do that, but Tesla could raise tens of billions of dollars of debt and do what Microsoft did, but doesn't do that. I don't think that's like Elon style. And I think that was the right decision. This is exactly what I said about a year ago too. That Tesla's not spending the kind of money Microsoft, Amazon, and Meta spent on Nvidia GPUs. Apple didn't do it either, you know. But that's a whole nother story. Okay, so that's Microsoft. I think it's just overvalued, due for a 50% pullback. Same as Nvidia, same as Tesla. All right, let's talk some Carvana while I have ACDC over here, because this is the type of stuff that I think he would be good at discussing. So, have you read the report?
I skimmed through it briefly, and there's some alarming things. And of course, they're going to hype up their report. They're a short seller, but reading stuff like subprime loans definitely brought some memories back. And we were looking at this. I remember we spent a distinct part of a space just discussing Carvana and its financials, but I don't think we discussed about their whole business model on taking out these loans to promote their sales. And if these are all subprime loans, and so they've just been pushing cars on the basis of that, that's going to come back and haunt them.
Right. All right, so I'm going to pin this report at the top of our screens. I replied to this space, so you can see it on my profile as well, and it's also at the top of your screens as well. Okay, so let's go through this. This is a lengthy report, so sit back, grab your popcorn. I think that this report is important for Tesla investors as well, because used car market is the dog that wags the tail of new car market here, or used car market is the tail that wags the dog. Dog is the new car market, tail is the used car market. So used car market trends are very important for all automotive investors, whether you're investing in dealerships or new car manufacturers. And this report also has a section on automotive industries, which I think is valuable for Tesla investors, long-term investors.
I just want to add one quick thing, Yaman, before you get into it. I think this report, as I was reading it, also sheds light on a lot of macro environment issues. And
right, exactly.
You should kind of look into it as to see what other companies these factors can also impact.
Exactly. Okay. Link is at the top. I'm going to read this. Let me see if I can put this on YouTube. Just give me 1 second. Sorry. You can just listen to it. I think most people are kind of listen to these spaces without being in front of their holding their phone in front of their computer. So you can just listen to me read it. I'll try to be clear. Carvana is a $44 billion online car dealer founded in 2012. Its main business is an online platform that allows retail customers to buy and sell used cars. Despite facing bankruptcy risks in 2022 and 2023, Carvana stock spiked 284% in 2024, with investors believing the company's worst days are behind it. However, our research, and including extensive document review and 49 interviews with industry experts, former Carvana employees, competitors, and related parties of the company, undertaken over the course of 4 months, shows Carvana's turnaround is a mirage. Our research uncovered $800 million in loan sales to a suspected, undisclosed related party. By the way, Hindenburg is the company that brought down Icon. So remember that as I read this. So this is not a, I think they were wrong on their Tesla short sale research report a few years ago, but I've been kind of keeping an eye on them in recent years, and they do actually a pretty good job. I think they were just off on Tesla like most other people. So let's continue to read. Our research uncovered $800 million in loan sales to a suspected, undisclosed related party, along with details on how accounting manipulation and lax underwriting have fueled temporary reported net income growth, all while insiders cash out billions in stocks, which is always a red flag if it's that big, right? When these are not just like a few $1 million sales, these are $1 billion sales. Even before considering the findings of our investigation, Carvana is exorbitantly valued, trading at an 845% higher sales multiple relative to online car peers, CarMax, AutoNation. So this part is my investment thesis. Like, I'm not claiming any sort of accounting irregularities at Carvana as Hindenburg is doing. It's not related to my my investment thesis on shorting Carvana is more around overvaluation. Okay, but Hindenburg research is going one step further and saying these are irregularities, accounting irregularities, manipulation, insider sales, and related party transactions. Okay, trading at an 845% higher sales multiple relative to online car peers, CarMax, and AutoNation, and a 754% premium on a forward earnings basis. The company has $4.8 billion in net debt and is junk rated by ratings agencies. Carvana's business already faces major headwinds. Used vehicle prices have declined 20% in the past 3 years, according to Manheim Price Index. Subprime auto loan delinquencies are now higher than during the global financial crisis per Fitch. So that is something that it relates to Tesla investment. That sentence right there. Subprime auto loan delinquencies are now higher than during the global financial crisis per Fitch. Now, a Tesla bull may say, what does Tesla have to do with subprime lending, right? It doesn't. Tesla does not sell. I think the average credit rating for a Tesla new car sale is above 700 credit score. So that's obviously not subprime, right? But what happens is subprime buyers buy used cars. And if subprime buyers cannot buy used cars because their credit is deteriorating, they're facing the rising delinquencies, that pulls away. So that lowers the resale values of the used cars. That hits the new cars sales in 2 ways. One, if I'm a potential buyer looking at both, either a new car or a relatively new used car, and the relatively new used car prices are sinking, I'm less likely to buy the new car. And the second way is if I trade in my used Tesla and I get less for that trade in, then I may not be able to afford the new Tesla. So used car market is the tail that wags the dog, which is the new car market. Okay. Now the report continues. Since 2023, previously, Carvana CEO Ernie Garcia's father sold $3.6 billion of stock between August 2020 and August 2021. In the year after he stopped selling, Carvana's stock plunged 99% and faced bankruptcy concerns shortly thereafter. In 2023, we see the same trend. Carvana has touted a bright future and posted 3 consecutive quarters of modest positive net income, an aggregate of $245 million despite stress in the used auto market. Now, by the way, I did a live, or maybe in Tesla Live we did this, a review of their last earnings report. And this is exactly what I point out too, that they're touting a bright future in the manager commentary that's kind of just based on hype. So The next point, for every $1 in net income it reported, the company has added $139 in market cap, a $34 billion market cap increase, with Carvana shares up 42 times. Father Ernest Garcia has sold another $1.4 billion in Carvana stock. That is math. I doubled my Carvana short this morning after the stock surged despite this report. And I was already looking to increase it, and I had been increasing over the last couple of weeks, but I doubled it further after this research report. I'm proud, there's other considerations. It's not just because of this research report, but I do respect this research company's report. So let's go through this a little bit more. As insiders unload stock, the company's solvency risks remain. Almost 26% of Carvana's gross profit consisted of sales of customer auto loans to third parties. Almost 26% of Carvana's gross profit consisted of sales of customer auto loans to third parties, largely in the risky subprime and deep subprime space. Gain on loan sales represented 2.2 times Carvana's net income in the past 9 months. That's insane. Okay, so this is what ACDC was talking about. Carvana has relied on purchase commitment agreement with Ally Financial, to which it sold $3.6 billion of vehicle loans in 2023, 60% of its total originations. Carvana has told investors for at least 6 years that it is seeking to diversify outside its relation with Ally, but thus far has not announced new financing partners. After calling off an earlier agreement in principle with Carvana around 2019, a Wells Fargo senior manager told us, as we dug into it, the more we learned, the less we liked about it. Wow. Let me read that again. Man, it's like, this is amazing. After calling off an earlier agreement in principle with Carvana around 2019, a Wells Fargo senior manager told us, quote, as we dug into it, the more we learned, the less we liked about it, end quote. They cited specific concerns about lax underwriting and related party loan servicing. As subprime auto has declined, Ally has amended its arrangement with Carvana 5 times in the last 2 years. Each time, Carvana redacts crucial information that would help investors understand the terms of this relationship. I mean, a lot of companies do that, so I wouldn't worry about that part too much. Let's continue. Over the last 2 years, Ally's loan book has become increasingly concentrated, with Carvana loans rising from 5% of its consumer auto portfolio to 8.4%. That's not much of an increase here, so skip that part as well. And so I'm going to try to kind of highlight the important points in this research report and just kind of say, no, this one is not that important. In September 2024, Ally stock fell 20% after warning investors that on the retail auto side, our credit challenges have intensified. Okay? Sales to Ally have scaled back year to date through September 24. Carvana sold $2.15 billion of loans in the Ally in the period, only 35% of total originations. This compares to 3.6 billion loans or 60% in 2023. So a significant drop in percentage of total originations sold to Ally from Carvana from 2023 to 2024. Okay. One Ally executive told us, quote, we've pulled back from Carvana pretty significantly in 2024. Ally's Carvana purchase commitment extends to January 2025. Posing a near-term risk to Carvana's business model should they renegotiate on less favorable terms. With Ally pulling back, a new unnamed buyer has quietly emerged exactly when Carvana needed it. In the past 2 quarters, Carvana sold $800 million of loans to an unrelated third party, in quotes. The mystery buyer made up 18 and 16% of total loan sales in Q2 and Q3. Okay, so this is the kind of stuff that is not part of my investment thesis. Okay, and this sounds more like a speculation and more like hype rather than like speculation and not hype, but like I wouldn't put money based on this. Okay, and I wouldn't even say things like, "Well, this is on like this is." Like I wouldn't place any value on these 2 sentences right here. But let's continue. Lien filings reveal the buyer is likely a trust affiliated with Cerberus Capital, where Carvana director Dan Quayle is chairman of Global Investments, indicating the new buyer is an undisclosed related party, contrary to the company's claims. Okay, so this adds a bit more weight, meat to the bone here, but let's continue. These suspected financing games are occurring as Carvana faces major economic headwinds. 44% of loans for cars purchased since 2022 are underwater, per a recent survey from CarEdge. Carvana's originate to sell model is highly skewed to packaging non-prime and subprime borrower loans. For a former Carvana director, quote, I don't think the model is much different than what we saw with kind of the early 2000 mortgage-backed securities, end quote, which is what ACDC also said. Almost 44% of Carvana's loans it sells in ABS deals are non-prime. Over 80% of its recent non-prime ABS deals have weighted average FICO scores in the deep subprime range. Wow. Let me repeat that. Over 80% of its recent non-prime ABS deals have weighted average FICO scores in the deep subprime range, the risk-based level per Morningstar data. Okay. Wow. So basically, the idea here is if you have a Tesla holding, long-term Tesla holding, and you just do not want to sell your Tesla holding, but you're increasingly worried about macroeconomic situation, it is possible to short this Carvana stock to hedge the market risk in Tesla stock, which means if the macroeconomics turn lower and we head into a recession like I expect, and I may be wrong, okay, but if I'm right, both of these companies would go down in price. And Carvana would probably go down lower, like more so than Tesla. So it's not a perfect hedge, right? Perfect hedge would be if they're moving 1-to-1. But I think Carvana stock may be a way to hedge some risk in Tesla holdings. ACDC, what do you think as a portfolio manager?
I'm sorry. Yeah, like I told you, I don't short stocks. I mean, the most that I go do is I go to cash. So I can't speak much to that. But I mean, yeah, I mean that's you could hedge your position in many different ways. I mean, Carvana definitely, though we talked about it before, and I agreed with you 100%. It was so overvalued at that time. It is incredibly overvalued even right now at these prices.
Let me kind of like think of these ways to hedge. I mean, you can't buy puts, you can't sell calls to hedge your positions, right? But I think selling calls has a pretty high risk. Let's say, for example, FSD hit. FSD became amazing overnight, and they sent out like a software update. You're gonna get screwed on your covered calls. You can buy puts, but you're paying high premium because the IV is just so high for Tesla. And you have to decide an expiration date as well. If you short Carvana stock, you can do that at zero cost. You know, a lot of brokers these days offer $0 trades. And you hedge your market risk and you hedge the automotive industry risk. The downside risk is if Carvana stock surges. And what is the problem? Like the risk here is if Tesla stock drops and Carvana stock surges. Now, if Tesla stock drops because of a company specific risk, let's say, for example, Elon got hit by a bus, there's nothing you can do about that. Like that's not the purpose of this hedge, right? But the risk here is, let's say, Trump administration comes out with a, cash for clunkers program. That would obviously help Carvana. Maybe, I guess, I'm not sure, depending on how it's written. But yeah, I don't know. I mean, I don't see how this company can go up in price. But let's say interest rates come down significantly. Auto loan, used cars, financing improves. Now all of a sudden, the subprime segment of the economy starts bouncing. These credit delinquencies start coming down sharply. Obviously, it's a high beta type of segment of the economy. So Carvana could get a boost. But in that scenario, Tesla would probably get a less of a boost. So I guess that's the risk of using Carvana stock to hedge your market industry risk for Tesla holdings. Does that make sense?
Yeah, I mean, they're not in the same market, so that's why it's not a direct hedge. So it's, I mean, like I said, I think it's a good short. It's way overvalued, and it's just like another market play altogether, which would end up hedging, a long position in Tesla.
Yeah, and I guess you could also like short Rivian with Carvana to hedge or short GM to hedge your industry and market risk as well. You could do a portfolio of shorts to hedge your Tesla holdings if you don't want to sell Tesla stock, for whatever reason, sentimental or tax considerations or whatever. Anyway,
You can short a lot of stuff, and not to give you any more ideas, but I was just looking at DoorDash.
all right. Well, let's look at that real quick before I continue with Carvana. $70 billion company, no earnings. Yeah, but you're not hedging your industry risk if you short DoorDash.
No, it was just a sheer short, nothing to do with Tesla itself.
Right. I'm going to look into that later. Okay. Let's continue with the Carvana report by Hindenburg. Carvana's toxic loan book is a result of lax underwriting standards. Quote, we actually approved 100% applicants, end quote, interview with a former Carvana director describing virtually non-existing underwriting standards. Carvana has issued over $15 billion of asset-backed securities, which it retains partial interest in on its balance sheet. 60-day delinquencies across its supposedly prime borrowers are over 4 times industry averages. A former Ally executive told us, quote, those numbers, my heart may have skipped a few beats. Those lost numbers are high. The delinquencies rose. 30-60 buckets are high. Carvana's subprime loans had the highest increase in borrower extensions of any subprime auto issuer. A major sign of stress per S&P data. Carvana's extensions more than doubled this year, while most peers saw declines. With its market collapsing, Carvana has propped up its numbers through a grab bag of related party accounting games. For example, Carvana's increase in borrower extensions is enabled by its loan servicer and a fleet of private car dealership drive time run by Carvana's CEO's father. The company seems to be avoiding reporting higher delinquencies by granting loan extensions instead. Interesting. In another example, I mean, I knew we talked about dry time before. I knew there was a related party, like a sister company, but this claim is pretty damning, right? I don't know if there's any evidence. The Hindenburg Research has a pretty good track record. This is something I would take with a grain of salt, but also to keep on your radar. Carvana's increase in borrower extensions is enabled by its loan servicer and a fleet of private car dealership drive time run by Carvana's CEO's father. The company seems to be avoiding reporting higher delinquencies by granting loan extensions instead. In another example, in 2023, $145 million of other revenue, or 8.4% gross profit, came from related parties. This includes $138 million of commissions and profit share from drive time. Interesting. Carvana appears to be dumping unreported costs of extended warranties onto the related party drive time, resulting in artificially inflated revenue and profitability. We estimate Carvana reports 58% more warranty income per sale due to the relationship. A former Carvana leader told us that warranty reimbursements from related party drive time were pretty generous back to Carvana as a way of showing better revenue to public investors. A former director told us, as a related party, we're Carvana able to kind of have an agreement that is favorable to pull as much of that profit forward. Additionally, instead of marking down inventory, Carvana can offload cars to related party drive time at a premium. Over the last 3 fiscal years, Carvana has generated $105 million of revenue from selling cars wholesale to drive time. Okay. Let's continue. A former Carvana director responsible for wholesale inventory told us, quote, selling cars to drive time is a lever that's not talked about. It's kind of like Fight Club. There's certain things we don't talk about, and we don't talk about trends. Okay. All right. Carvana engaged in sham deals with Drive Time, along with numerous other improprieties per allegations in 2024. 332-page amended class action lawsuit brought by 2 pension funds, which included information from 12 confidential witnesses. These sketchy related party dealings seem to be enabled by conflicted board members. Carvana's independent audit committee has 2 individuals that served on the board of related party Drive Time. Wow. One independent member of the audit committee, Greg Sullivan, was previously suspended by the New York Stock Exchange after he sent money to Carvana's CEO's father in contravention of a prohibition order per legal records. Wow. Carvana's CEO's father, the key shareholder dumping billions in stock, previously pled guilty to felony bank fraud over allegations that he helped the company report fake accounting income through sham transactions. SEC charges also alleged he signed a falsified letter for the company's auditors. In addition to the grab bag of related party tricks, Carvana exhibits a litany of other accounting issues. Carvana's CEO has said, quote, "We don't end up taking the credit risk over an extended period of time. Yet Carvana's loans held on its books have increased 50% since 2021 to $553 million in Q3 2024. Carvana uses an accounting treatment that records no loss reserves on these loans at booking. A former executive confirmed that Carvana could move very large amounts of income around quarter to quarter by holding loan sales over the quarterly line. For example, on May 4th, Carvana reported Q1 earnings showing 41% year-over-year decline in loan sales, swinging to negative adjusted EBITDA amidst bankruptcy concerns. CEO Ernie Garcia blamed the delayed loan sales on uncertainties in the securitization market. Against this backdrop, the stock price depressed. The Garcias signed an agreement to purchase $126 million in Carvana stock on July 17th. 2 days later, Carvana announced the best quarter in company's history, featuring a massive earnings beat from reaccelerated loan sales as well as the successful restructuring of its debt. The Garcias are up $427 million on those precisely timed purchases. Wow. In Q3 2024, Carvana reported $3,500 in retail gross profit per unit, a key metric for investors to understand the profitability from the sale of retail units. Carvana inflates this metric by 34% by dumping an estimated $390 million of selling costs into SG&A annually. In stark contrast, this makes sense. We talked about this too. Because people keep talking about Carvana's gross profit per unit, and I'm like, okay, where is it in the bottom line? So they must be shifting a cost to SG&A, and that's exactly what this report claims. And they're more detailed than my kind of back of the envelope understanding of the company. In August 2023, Carvana told investors its cost reduction measures did not impact quality, but a former recondition leader told us otherwise. They did make an adjustment to the standards, but only for that segment. They called it their economy line. I don't think they talk about that. Overseeing all this for 10 plus years is Carvana's mid-tier auditor, Grant Thornton. Grant Thornton is not a mid-tier auditor. I mean, it's not a big four, but it's a reputable company. Okay. But sometimes what people miss about these auditors is that it is not the auditor's responsibility to ensure that these things are up to par. Okay. That's not their responsibility. Legal responsibility is not on the auditor. It's on the management. The auditors are relying on management statements. So if there's fraud or misstatements, material misstatements, even though auditors get the kind of like lashback in the headlines, it's really the management that goes to jail. Okay. So even Lehman Brothers, I think Ernst & Young was the auditor at Lehman Brothers, and Ernst & Young got hit substantially in the headlines and got slammed. But I think at the end of the day, if I'm not mistaken, Ernst & Young wasn't even, I don't think they saw many like large repercussions from that audit engagement. I think it's Lehman Brothers management. So, there's no point in shaming Grant Thornton. I think that's a fine auditor company. They're not Big Four, but they're right up there. Okay, overseeing all this for 10 plus years, Carvana's mid-tier auditor Grant Thornton, which also has had a relationship with a related party Drive Time. Quote, we're not doing what the market thinks. We're not looking for fraud. Exactly. Oh, that's exactly what I said. That's literally what I just said. We're not looking for fraud. We are not set up to look for fraud. End quote. Former Grant Thornton UK CEO. Finally, Carvana is subject to an undisclosed SEC investigation per Disclosure Insight, a Freedom of Information Act intelligence firm. We think the company should clarify to the market whether it has faced SEC. This is the fluff stuff on their short report. Overall, we think Garces will have leave shareholders with nothing. At any point, that's speculation. At any point in Carvana's two incredible stock runs, it could have raised significant capital and de-risked its balance sheet. Instead, the company has pushed off creditors or engaged accounting games with it, while the CEO's father dumps billions of stocks. Okay, those are facts. The CEO did dump billions of dollars of stock. We think Carvana is truly an accounting grift for the ages. Speculation. We see rough times ahead for both stockholders and bondholders. Okay. Disclosure: after extensive research, we've taken a short position in the shares of Carvana. This report represents our opinion, and we encourage every reader to do their own diligence. Please see full disclaimer at the bottom of the report. Okay, so far, what we learned here is Hindenburg highlights that the company, based on traditional metrics, is overpriced. I'm seeing a wave of people come into this space. So we talked in the first half hour about Tesla. If you're interested in that, I recommend going to the YouTube channel and starting from at the beginning. Currently, we're talking about Carvana. Okay, we're reading through the Hindenburg research. I think Carvana is a great way for Tesla investors, or one way. I don't want to. Look, this is not financial advice. Obviously, do your own diligence or whatever. But I think one way to hedge market and industry risk in Tesla stock is shorting Carvana stock. Okay. So now the Hindenburg research report goes into more detail on Carvana, and now we're going to read through the industry trends which are applicable to Tesla. Okay, so bear with me. Background: $44 billion online used car retail. Carvana is a $44 billion online car dealer headquartered in Tempe, Arizona. The company was founded in 2012 and is led by co-founder, chairman, CEO Ernest Garcia III. Carvana's main business is an online platform that allows retail customers to buy and sell used cars, which account for 70% of its total revenue, for the company's latest quarterly report. The company offers financing, insurance, and other services like car protection plans. Okay. The company also runs a wholesale auction business called ADESA, which it acquired in May 2022. ADESA has 56 locations where registered other dealers can participate in auctions, either virtually or on site. Carvana also acquires vehicles in these auctions. Carvana originally spun out the company called Drive Time, a used car dealership chain run by Ernest Garcia II, a Carvana key shareholder and a felon convicted of bank fraud in 1990. Garcia pled guilty to charges alleging he helped the company report fake accounting income through sham transactions. SEC charges also alleged he, quote, signed a falsified letter for the company's auditors, end quote, as part of the scheme. His son, Ernest Garcia III, has been CEO of Carvana since its inception. Carvana went public on NYSE via direct listing on April 28, 2017. It currently has a market cap of $44 billion. Bull case: a disruptive online car dealer covering nearly all of the US with industry-leading unit economics. The US used car industry is projected to reach $600 billion in 2024, but remains fragmented, with many traditional dealerships serving a small submarket. Carvana now operates at scale, having expanded its presence to cover 81% of the US population per Q3 investor presentation. Carvana had over 45,000 vehicles available for sale on its website as of September 3rd. Carvana prides itself on a simplest differentiated used car buying experience where customers can purchase cars online rather than dealership showrooms. The company's platform has been described as the Amazon of cars by Forbes. In September 2023, amid fears of bankruptcy, the company aggressively restructured, working with creditors to slash $1.3 billion in debt. Since then, the company has focused on a three-step plan that includes 1, driving the business to positive EBITDA, 2, achieving positive unit economics, 3, returning to profitable growth. Pursuant to this three-step plan, Carvana has significantly improved its reported unit economics. The retail vehicle gross profit unit has increased from $1,100 in September 2022 to $3,500 in September 2024, representing a 209% increase. The GP, this gross profit per unit is 54% higher than compared to the CarMax equivalent metric in Q2. With Carvana's share price rocketing up over 284% in 2024, investors believe the company's worst days are behind it. Fundamentals. Carvana trades at an 845% higher sales multiple than online car peers like CarMax and AutoNation, and a 754% premium on a forward earnings basis. Even before considering the findings of our investigation, Carvana trades. So this is the part of my investment thesis right here, the fundamentals. Even before considering the findings of our investigation, Carvana trades at exorbitant valuations relative to online car peers such as AutoNation and CarMax. On a 1-year forward price to sales basis, Carvana trades at an 845% premium to peers. On a 1-year forward PE basis, it trades at a 754% premium to peers. These extremely optimistic valuation multiples appear to factor in a high probability of continued growth that will result in vast runaway profitability. Carvana's valuation also seems to take for granted that the company can overcome its current debt burden. Carvana has the lowest credit rating among its peers at B-, junk, per the Bloomberg data. The company remains significantly indebted, with net debt currently $4.8 billion as of the end of September 2024, 4.4 times the company's LTM adjusted EBITDA. As part of the Carvana's 2023 debt restructuring agreement, the company had foregone paying cash interest payments and chose to increase its principal balance. Now, starting in February 2025, the company is due to start paying cash interest of $215 million per year on a $2.4 billion outstanding long-term debt. Okay, so I didn't know this. This is new information. And that's pretty bad, ACBC. Let me repeat that. As of Carvana's 2023 debt restructuring agreement, the company had foregone paying cash interest payments and chose to increase its principal balance. Now, starting in February 2025, the company is due to start paying cash interest of $215 billion per year on $2.4 billion outside long-term debt. That's crazy. What do you think on that?
Yeah, that's a snowball effect coming up here.
Yeah. Fundamentals. Carvana's business is highly cyclical and faces major headwinds. Subprime auto loan delinquencies are higher than during the 2007-8 global financial crisis per Fitch. That statement is damning for Carvana, is also applicable to Tesla through the used car market. Okay. Used vehicle prices have declined 20% in the past 3 years, according to Manheim Price Index. The auto industry is highly cyclical, driven by broader macroeconomic factors like interest rates and employment rates. Carvana acknowledges this in its own risk factors, stating that its financials may be impacted as a result. Okay, that's every automaker does that. Every company does that. Heading into 2025, signs of stress are increasingly evident in the U.S. auto loan market. Subprime auto loan delinquencies are currently higher than during the global financial crisis of 2007 and 8 per credit rating agency Fitch. If you want to follow along, the link is at the top of our screens. Auto loan 60 plus delinquency index is higher than the global financial crisis of 2007 and 8. Wow, that's wild. That's wild. Prime market is fine, but prime market doesn't deteriorate until you get a financial crisis, which is usually led by the subprime stresses. But maybe this time is different. Who knows? Approximately 44% of cars financed since 2022 are underwater, meaning they are in negative equity, per report by CarEdge in December 2024. As detailed later, Carvana has heavily focused its operations on the riskiest subprime and deep subprime consumers most impacted by this problem. Used car prices have fallen by 20% since their peak in January 2022, according to Wiley Track Manheim. I'm going to skip this part. This is all right. We already know that. Lower prices generally have a negative impact on gross profit, etc. While Carvana's claimed profitability has not reflected these pressures, other reported Carvana metrics are not immune to the cyclicality. Carvana's quarterly sales still have not reached peak levels seen about 2.5 to 3 years ago. Okay. Background: Carvana CEO Ernie Garcia's father, Ernest Garcia II, sold $3.6 billion in Carvana stock between August 2020 and August 2021. Oh, that was the last peak. In the year after he stopped selling, Carvana's stock plunged 99%. Within 16 months, Carvana was facing bankruptcy concerns. The Garcias knew it was short-lived. The Garcias knew the music would eventually end, Wharton professor Dan Taylor said. Despite volatility in Carvana's share price, one key shareholder seems to have timed the market for selling shares with surgical precision. Its largest holder, Ernest Garcia II, whose son happens to be the company's CEO. Between August 2020 and August 2021, Ernest Garcia II, father to Carvana's CEO Ernest Garcia III, sold 3.6. Okay, you're just repeating yourself here. On August 5th, as his sales were concluding, the company was touting a bright future. Quote, this is from the earnings call in Q2 2021. Our results relative to the industry leave us more optimistic than ever about our long-term model and path toward our goal of delivering more than 2 million retail units per year and becoming the largest and most profitable auto retailer. Q2 2021. That's amazing. Ernest Garcia II sold his last tranche of sales about 2 weeks later on August 23rd, 2021. Despite his son's company touting the path to becoming the most profitable auto retailer, Carvana rapidly turned loss-making, swinging from a net income of $45 million in Q2 2021 to a net loss of $68 million in Q3 2021. The company that reported 7 consecutive quarters of losses, totaling $3.5 billion. The stock plunged 99% in the next 15 months. Within 16 months of the CEO's father's ending his billions of share sales, the company was facing bankruptcy concerns. That's incredible. That's incredible. Commenting about the collapse of the company's stock, the Wharton professor Daniel Taylor told Forbes, quote, what I'm saying is that Garcia knew it was short-lived. The Garcia knew the music would eventually end, end quote. Since 2023, the same trend has restarted. Carvana has touted a bright future and posted 3 consecutive quarters of positive net income, an aggregate of $245 million. For every $1 net income generated, the company added $139 per share in market cap, representing a $34 billion market cap increase. With Carvana shares up 42 times, Ernest Garcia II, the father, has sold another $1.4 billion in Carvana stock. The same pattern seems to be playing out again. Just like in 2021, CEO Ernest Garcia III touting Carvana's incredible results over the last 2 years and reiterated in a February 24 statement, quote, we plan to become the largest and most profitable automotive retailer and buy and sell millions of cars per year, so we need to keep marching, and we will. Over the last 2 years, since its restructuring, Carvana has seemingly flipped a profitability switch. Between Q3 2022 and Q3 2024, the company's net income margin went from negative 15% to plus 4%. By reporting just $245 million in net income in the past 3 quarters, Carvana stock added $34 billion in market cap, or $139 in market cap for every $1 net income. Wall Street analysts have celebrated the turnaround, declaring the worst is behind the company and touting the further upside beyond the stock's triple gains in the past year. And once again, despite his son's optimism and the company's recent positive metrics, Ernest Garcia II has aggressively sold stock. He dumped $1.4 billion in Carvana stock over the last year, at times selling on a nearly daily basis, making him by far the largest insider seller of the company's shares. During this time period, only one insider bought shares in the company, board member Nia Parikh, who bought 2,600 shares, or around $77, for approximately $200,000, which obviously is nothing. Oh my goodness gracious, how long is that research report? We're like 1/4 of the way. I need to dedicate a week of Tesla live spaces to read this thing. What the hell?
I think we got the gist of it.
Let me just go through the headlines, see if there's anything interesting here. Goodness gracious! I mean, if they just repeat themselves less, we can do this in 1 hour, not 1 week. Lax underwriting, uniquely toxic portfolio, subprime model. They have some details around that Carvana receivable trust, so that's good. FICO scores ranging from 567 to 584. I'm not been looking for ways to kind of short subprime too, so this is a great short on many fronts, I think. Like this short hits all the points that we've been discussing over recent weeks about macroeconomics, microeconomics, insider sales, industry risks, and now, which wasn't part of my thesis at all, the accounting concerns. Basically, more details and meat around what they have discussed in the previous, what we had discussed in the previous hour.
So
If you
on
want
the
to
flip,
read, there's some quotes from interviews they conducted, some comparable company analyses as well, and I'm going to read this on my own time. There's some reference to legal documents, and we're going to discuss tomorrow again Carvana shorts and some takeaways. Please go to the top of your screens, click that link, and read that report as well. If you're interested in a short position Carvana, you should read this report and come up to speaker board and discuss the position. ACDC?
so would you agree that their only lifeline is literally rates going down really, really low? And because that would help not just the sales, but also their loan portfolios, right?
Yeah, and Powell's already said he's not going to do that, right?
Exactly. I mean, I don't see. I mean, the only way he would have to do it is if the economy tanks, and if that's the case, then Carvana's already gone before they even get to the lower interest
Yeah.
rates.
I think what we're going to see across the auto industry and housing industry. So we're talking 5 to 10-year yields. Okay. We're going to see credit spreads widen. Credit spreads today are at the lowest level in decades, meaning the risk taking is at historically high levels, record levels. This is also apparent in surveys of investor sentiment, apparent in cash balances in portfolios, apparent in Bitcoin prices, like the prices of assets that really don't have backing. They're more speculative than anything else, and also apparent in overall stock market wide PE ratios, and also apparent in the Warren Buffett ratio, so valuation multiples in general. So this is a bubble set to pop, in my opinion. And treasury yields have risen 100 basis points, as you all have learned from many interviews if you're following this kind of stuff, after the Fed cut short-term lending rates by 100 basis points, the federal funds rate by 100 basis points. So now I think next, and there are people, I mean, T. Rowe Price, I have another tab open here that I need to read this, but the headline of this research report by T. Rowe Price, a very respected firm, also a major holder of Carvana stock. Okay, as of September 30th. We're going to get the December 31st numbers on February 15th. My guess is that T. Rowe is going to sell Carvana stock very rapidly in 2025. But T. Rowe Price warns treasury yields could hit 6%. Okay. So if you have this and also a blowout in credit spreads due to weakening employment market, weakening consumer sentiment, rising delinquencies on credit cards and auto loans, the company, like if you give me that scenario and say which company do you short, Carvana, hands down. So I think it's a good way to hedge market risk and industry risk for Tesla investors who don't want to sell their Tesla shares. ACDC?
I'm actually surprised as you know, and kind of what you were talking about as to why the stock has bounced right back up and is continuing to do so. But it's because 93% of the holders are institutional holders. So these guys are not going to just react on this report right away.
But see, you can't
Most
say
of them
that.
are.
You can't say that, right? The only thing you can say when it comes to that is, let's say 93% institutional was as of September 30th, 2024. We don't know the December 31 numbers.
Well, yeah, but if you remember, we kind of did a deep dive into that. We looked at all the funds, specific funds, T. Rowe Price, Fidelity, and everything. And these were all kind of mainly index funds. Some of them were large cap growth funds, tech funds or so, right? So it's not changed. If anything, with the market, it probably went up a little bit, but it's not changed. And Carvana stock back down a little bit towards the end of the year, but I don't think it's changed relatively. I mean, you only have a 7% retail float there, you know, so that's why you're not seeing a lot of price action in it today.
I mean, it's really amazing that the stock popped 10-15% after this research report was published. Hindenburg Research has a good reputation. I think overall their track record is really good. When they announced, I actually asked ChatGPT 01 to do an analysis of 1 day, 1 week, 1 month, 1 year returns for their short ideas. And ChatGPT is obviously the cutoff date is in. It's not as late as I would like, but throughout 2020, 2022, and 2023, it came out with the results that are very impressive. 1 day, 1 week, 1 month, 1 year returns are all negative for pretty much all of the ideas. Did they get some things wrong? Of course. I think if I remember correctly, back in 2018 and 2019, Hindenburg published a negative report on Tesla, and they were wrong about that. They also had a wrong call on one of the companies I can't remember the name of right now, but just kind of, and nobody's perfect, obviously. So I suspect, like my price target for Carvana is 0. My price tag for Tesla is $200 to $100, depending on your assumptions for, recession and what the 2025 deliveries are going to be. But Nvidia isn't going to go to 0. Tesla isn't going to go to 0. Microsoft isn't going to go to 0. I'm also short now slightly on Berkshire Hathaway. That's not going to go to 0. Those are market calls. This one is different. Carvana short is different. Like I'm also short Axon, AXON. That's not going to go to 0 either. I think this fundamental strong company, but the stock price is way detached from fundamentals on that one. But Carvana has potential to go to 0. So, and the IVs on Carvana, like premiums on Carvana, are not that expensive. So if you want to buy puts instead of selling stock short directly, you could do that too. You could write calls. You could do whatever. A bunch of different ways of short bidding against the company. So, I mean, I increased my Carvana short when the stock price popped up today 15% after this report was published, which makes no sense whatsoever. And then since then, it came back down in the afternoon, back to those lower levels. So the 200, if you look at technical analysis stuff too, if you're interested in that kind of stuff, the $200 per share level, the 190 to 200 level is a bit of a sport for Carvana stock. So, and this is a stock that has massive capital gains baked into it over the last 2 years. I mean, the stock went up by, since the end of 2022, okay, the stock went up by 50 times, 54 times. So I believe some investors have been expecting, waiting until January 1st to sell their stock. And so I think we're going to start seeing that those sales come to market, throughout January as well. ACDT?
I think you're going to start seeing those sales come into the market starting next week itself. Most fund managers, portfolio managers are still off this week. Trading volume is not going to be high right now. But like you said, it has a lot of built-in capital gains. And these fund managers, they try to avoid year-end capital gains because it really creates a negative outlook on their funds when they're kicking out huge capital gains for their specific funds. So this will be a top pick right now, and I think the race is going to be who gets in first. And you're going to see some significant selling coming in starting next week itself. That's my take.
Yeah, possibly. And then the other thing was this stock got added. Was it? Yeah, I think Carvana got added to Nasdaq 100 last week or the week before. So T Rowe Price may have unloaded to index funds as well. Anyway, all right. Anything else on Carvana, Nvidia, or Tesla, or any other stock? Markets in general, macroeconomics, anything else? Otherwise, we're going to end the space. Let's look at a quick check on Tesla FSD tracker, which now has a significant amount of miles logged in for V13. TeslaFSDtracker.com shows 6,000 miles logged in for V13, 96.9% of trips with no critical disengagement, 86% of trips with no disengagement, and 260 miles to critical disengagement. I think some of these critical disengagements logged in are not really critical, but also this tracker doesn't account for critical interventions. So if you don't disengage, but you're accelerating or you're changing lanes for a purpose that is really critical, in my opinion, that should count as a critical intervention. But Elias doesn't think so. So the tracker doesn't show those. So therefore, I still want to see tens of thousands of miles logged in before you kind of jump to conclusions here. Ideally, you want to see on a major release basis, so V13, V12, V11, V10, you want to see tens of thousands of miles from thousands of entries, diversified across the nation, not just from 1 or 2 or 3 states. So that's going to happen sometime in March. It depends on Tesla's wide release of V13, which is still not in wide release by my definition, which is majority of Teslas in the eligible areas. So that would be US and Canada. So, we got to see 2+ million Teslas installed V13. That's not going to happen until March. At that point, I think we're going to see V13 miles to critical disengagement, a few hundred miles, let's say 300 to 400, and percentage of drives with no critical disengagement at between 96 to 97%. And this is very much in line with my expectation for FSD progress. I'm going to pin at the top of our screens for my forecast for FSD progress. Okay, this forecast got a vote of confidence from George Hotz, to the extent that you kind of care about that kind of stuff. And he replied to the tweet, and you can see the replies. And here is at the top of our screens that post. And so this is the forecast that you can hold me to. I think hardware 3 peaked at 90% trips completed without a critical disengagement. Hardware 4 is going to peak at 99% within the next year or 2, let's say 2 years. And then you're going to need hardware 5 to get to 1 more 9, hardware 6 to get to 1 more 9, hardware 7 to get to 99.999% of reliability. But it's going to take hardware 8 after 2030 plus to get to robotaxis, in my opinion. Okay, so that's not for another decade. And you can hold me on to this forecast at the top of our screens. Bookmark it, print it, whatever, and remind me after if I'm wrong. All right, ACDC.
What about the geofenced areas that they're planning to launch this year? Austin, maybe California. You don't think that's going to come with V13 or even hardware 5, let's say?
Yeah, I think it could be like hardware 5, maybe next year. I don't know if it's going to happen this year, maybe next year hardware 5 after much data collection and validation over many quarters, they can start on FSD unsupervised in limited operational domain. So that could be certain routes in Austin, San Francisco, let's say Omar's block, and maybe like portions of the highway or something. Who knows? I think that's going to be maybe come later, but I don't think that's going to be material to the stock. Anything less than $1 billion of annual profits is not material to Tesla. And I used to say that when Tesla stock was at 200. So now you're talking billions of dollars. So anything less than billions of dollars range is not material to the stock. Profits, not revenue. So let's say they did all their several quarters of validation, got the permits, and introduced it, and maybe started expanding in the following year. You're still not going to generate billions of dollars in profits. And who knows how the competitive landscape is going to look like in 5 to 10 years. From Waymo, from Zoox, Chinese automakers, and Beijing apparently approved some sort of regulation to allow autonomous car testing. They have dozens of companies that are doing the same thing. And government protectionism that we discussed earlier in this space is going to apply not only on the vehicle sales, but also on energy, on robotaxis, on Optimus. So the future is very uncertain 5 to 10 years from today, especially when interest rates are so high and I'm worried about the recession risk in the near term. So despite that, I'm giving a $200 billion value to robotaxis and Optimus as of today. So yeah, they may start something in the next couple of years in limited areas, but I don't think it's going to be material.
So let's say if the market weakens in the first half, starts firming up in the second half, right? And that's about when Tesla announces these geofenced testing places. Tesla's always been a stock that trades on headline news. You don't think it could trade higher just on that headline news to shore it up for a few years?
You mean like at the end of this year? Man, it really depends on where the stock is at that point. So ask me at the end of this year. Like if it drops below 100, then sure. If it comes to just 200, then you're just looking at support. Like Semi, when Tesla announced the Tesla Semi back in, I think it was May 2018, the stock popped like 5-10%. And everyone was so excited. It's 6 years later, almost 7 years later. And let alone shipping Tesla Semi in volume to other customers. All this hype around, we're going to eat our own food, deliver our cars using Tesla Semi. Where are those semis? Yeah, they're using a handful of them, but are they doing most of the logistics with Tesla semis? No. 7 years later. And there's nothing software about this. This is a hardware. So sometimes people say, software is hard to forecast, but hardware, Elon's always right. That's not true. So I wouldn't hang my hat. The only reason I'm putting $200 billion fair value to Optimus and robotaxis is because, most people think you got to put something in there. So I'm just like, whatever. Go ahead.
Yeah, I believe a lot of that is already built into the price. And now, if anything, Tesla has to prove itself to justify that price. And if there's any mishaps throughout the time or any delays, that's just going to add further pressure.
Yeah, exactly. Well, I want to end on a positive note. So I'm going to read this YouTube comment. Satvik says, I hate you. Thanks, Satvik. On that note, thank you very much, everybody. And I will read about this Carvana note from Hindenburg Research, and we'll continue chatting tomorrow. Take care. And Happy New Year.